Trading plan is what's going to allow you to grow your account, but risk management plan is what's going to allow you to survive in trading. It's what's going to allow you to sustain and play the long game. If you want to trade for a few years, like literally treat trading as seriously as possible and treat it like a business and not just like a hobby, so that the market don't treat you like a joke, you need to practice proper risk management. So the question becomes, what is risk management? So risk management is basically a set of rules you implement to ensure that the impact of being wrong is tolerable. So that is the definition of risk management. And what does it really mean? It basically means that you will lose money in trading, but in order to become consistently profitable, you have to win more than you lose. When you win, you have to win big. When you lose, you have to lose small. And in order for that to happen, you need to make sure that when you lose, you are losing as little money as possible, right? The loss is not so big where, you are literally risking 1/4 of your whole account on one trade. And the thing about risk management is that if there's no risk, there is no reward. No risk, no story, right? To achieve anything success, full, like genuinely like great, you need to risk some sort of things, right? And in trading, that is your hard-earned money. And bear in mind that you are a trader, not a gambler. I want to instill this mindset into you guys. You are a trader, not a gambler. Gambler. A gambler is the guy who go to the casino, decide to bet like this amount of money and this amount of money, and then eventually given all in, all in. Let's put all my chips into the poker table or the slot machine. You are a trader. A trader is the guy who take calculated risks. A trader is the guy who knows how to manage his risk so that he can stay in the long term and he can actually make consistent profits. Like I said, this is absolutely essential, all right? It's not okay, you know what, maybe you don't need risk management. It is essential, right? You need risk management if you want to become profitable. So risk, the definition of risk is basically the amount of money you are willing to lose for every trade that you take. So if you have $1,000 in your account and you want to risk $100, then by all means, go ahead, risk $100, and that will be your risk, right? So it's basically the amount of money that you are okay with losing. So in risk management, there is 3 rules that I want you guys to master. We will go through each one of these rules in the following lessons, where we talk more about risk management, like leverage, risk per trade, risk to reward ratio, risk capital. All these terms we're going to talk more later. But for now, since this is just like an introduction, you guys must know why risk management is important and how risk management is important, and basically this just shows you, right? So example, the first rule is the maximum loss on a given trade should not exceed 1 to 3%. That is the standard rule. The reason why we keep the maximum loss so low is because if we only risk 1% per trade, we can lose 100 trades in a row before we blow our account, before we lose every single money we have in our account. If we reach 3% per trade, we can take 30 trades before we even, we can lose 30 trades before we can even see our account balance go to 0. So it gives us this large room for error, right? Ensuring that, even if we encounter a losing streak, which is very common by the way, it is okay, right? It is okay. Rule number 2 is to carefully determine your position size based on applied leverage. Right, the second rule of risk management is that you need to make sure that when you are trading, you are using the correct position size. And this depends on your account size, your risk tolerance, your risk per trade, your stop loss distance. All these things determine how wide or how tight your stop loss is. Ideally, we want to have like a tight stop loss, but that's cannot be always the case, because there's sometimes where we might enter the trade a little bit too late, and then the stop loss distance have to be a little bit wider. In that case, you need to adjust it so that, it is still low and it actually fits your risk per trade. Don't worry if you still don't get it. I will talk more about this later on what, how, or why, or how do you choose the correct position size when you are trading. Rule number 3 is where we talk about how you need to maintain a consistent risk to reward ratio for all your trades, and it should never ever be 1:1. 100%. It should never ever be 1:1. Because if you're trading, you should want to get back in return at least twice of what you're risking. It doesn't make sense to risk $1 to make $1. Then why would you even risk in the first place? It's counted as a risk because you're expecting something higher in return. So 1:1 is a no-go. At least risk 1:2. Once again, I'll talk more about all of these rules in detail later. But for now, you guys understood why risk management is important. It's because you need it to survive in this market. You need it if you want to trade for the long term and actually, become a full-time trader. You need to preserve your capital in order for that to happen. Because imagine you start off trading with $100,000. That's all your money. That's all your life savings, and you jump into trading full-time with 100K. And you start taking trades. Boom, boom, boom. And you risk 10% on each trade. Boom, 10%, 10K. And you lost that trade. Then you risk another 10%, boom, 10K, and you lost another trade. And then you keep on doing this until you eventually lose 100% of your capital. And guess what? Now you're broke. You have no money to trade with anymore, and now you have to go get a job at McDonald's or some shit just so that you can raise capital again, so they can trade again, right? And it all comes down to risk management. If you practice proper risk management in the first place, you risk 1% instead of 10%, then you lose 10 trades in a row? You only risk 10%. I mean, you only lose 10%, which is okay, right? It's still easy, or rather doable, to earn back that 10% and eventually grow your account, right? So bear in mind that no risk, no story. Once again, these are the 3 rules that you guys should really take into account of when crafting your risk management plan. And this whole syllabus right here, risk mitigation framework, is where I give you the details you need to know in terms of how to manage risk when you are trading. And your job is to go create a risk management plan out of these rules, right? Have strict rules where, you must obey these risk management rules when you are trading. Because if you have rules and you trade based on your rules, your trading will be less emotion based, and it'll be much more rules based, where it's much more rational and logical. So that is generally how you can use risk management to your advantage. Okay, so I'm gonna share with you guys everything on the whiteboard so that it's much more easier for you guys to understand. So the first thing I really want to talk about is what we call your risk capital. Now, what is risk capital? Risk capital is basically the amount of money that you are putting into your account, right? Your trading account, your live trading account. And you can see risk capital can depend on, it's different for everybody, right? Like, I might be okay to put 100K into my live account, right? 6 figures into my live account. But you might have less than $1,000 in your bank account, and then in that case, you might only want to put in $100 into your live account, right? So it's really different for everybody. And the main concept on risk capital is you should only be putting money that you can afford to lose. That's it. You should only be depositing money that you can afford to lose into your account, into your live trading account. I want you to go into this mindset where whatever money that you deposit into your account balance, treat it as you just lost that money. It's no longer yours. And when you do this, right, this gives you what we call a detachment, right? What we call a detachment, where you are no longer constantly worrying about the money, paying bills and, paying for food, because this money here is just disposable income. It's not your life savings. It's not the money that you need to depend on in order to live, in order to survive, right? Because this is just disposable income. So for example, let's say you have $5,000 in your account, even though most people don't even have $5,000 in your account. But let's say that you are somewhat like have a stable job and stuff, and you've managed to save up like $5,000. $5,000, you shouldn't be putting all of these $5,000 into your live account. I did this last time where I would only have like $500 in my account, and then I'll deposit all of it inside my live trading account. And when I do that, I start taking trades, and every single trade I take, my heart started beating faster and faster, because if I lose this trade, I am literally going to be broke soon, right? And I was risking like what, $20 or even $50 on each trade, and I lost like 10 trades in a row, and I just blew my $500 account, and I have $0 in my live account. I also have $0 in my bank account. That was the worst part. So generally, let's just go back to this, right? You don't want to put 100% of your money from your bank account into your trading account. That means it shouldn't be 100%, right? Right, what's a good range? I cannot really tell you the exact amount or a good range, a good percentage to put inside a live account, because I'm not a financial advisor here. But if you really want to, it should be no more than 10%, honestly. No more than 10%. So if $5,000 and 10% is probably like what, $500? Yep. You should only be putting $500 into your account, right? That is my rule of thumb, right? Because this is a good percentage where you won't feel so attached to the money. So the other 90% right here, right, which is what, 4.5k, right? 4.5k. This amount of money you can use to, go pay your monthly expenses, your transport, food, put food on the table, pay your phone bills, all these things. You need this money, all right? You need this money. That is why when people ask me whether they should quit their job to trade, I would literally never advise them to quit their job to trade. Like, generally, you should have some sort of like income on the side when you are trading. When you're just starting out and you're not profitable yet, you shouldn't just solely depend on trading. You need to have some sort of income. So in that case, the risk capital here we had was $500, and it was 10% of our total money that we have in our account. So this was the total capital, and this is what we call the risk capital, right? So this is the amount of money that you're gonna put inside a live trading account. So like I said, I genuinely would not recommend you to put more than 10% into your live account, because the thing about trading live is that the first few times that you trade live, you will lose money, right? You will lose money, and you might even blow accounts. I myself, I blew my first account, and I deposited more money into my second account, and I blew my second account, and I deposited more money into my third account, and just went on and on like this. And I just, just keep on losing every single cent that I have in my bank account, and I just don't want that to happen to you guys, right? It's a very like depressing state where you have $100 in your bank account and you lose that $100, and then you have to wait until next month. Then you get your monthly allowance from your parents, which is another $100, and then you lose it again and again and again and again and again. It's absolutely the worst feeling ever, and I don't wish it on my worst enemy. And just don't, guys. Just don't. Right? Just practice this rule, and you'll be fine when it comes to risk capital. Now, the next concept I want to talk about is actually what we call the risk per trade. Right? Risk per trade is basically how much money that you are willing to risk on each trade. How much money are you willing to lose on every single trade? To show you an example of how all this risk per trade stuff works, let me just draw it out for you guys to see. Let's say you got a chart right here, right? Go away, Miro. And then let's say price is at, consolidating right here, and it's at this support level right here, right? There's a support level right here. Now, at this point of time, you enter for a buy somewhere right around here, okay? You enter for a buy right here, and you probably have like your stop loss down here below this support level here. And then our take profit could be all the way up at the next, key level or Fibonacci extension level. So all the way up here. So this is your stop loss, and this is your take profit. In this case, your risk per trade is basically the amount of money that you will lose if price goes down and hit your stop loss. Okay, so if your risk per trade is, let's say, $10, right? You need to make sure that the lot size that you're using right here for this buy position, for this long position, correlates to this $10. So if you hit your stop loss, the maximum amount of money you will be losing is only $10. Right? It's only $10. And then in this case, let's say that we have a 1:3 risk to reward ratio, right? Which means that if you lose, you are losing like 1% of your capital, which is $10, right? And then if you actually win this trade and price goes up there, hit or take profit, you'll win about $30. 1:3, right? Risking 1% to make 10%, risking $10 to make $30. In this case, this is your risk per trade, where you are thinking about how much money that you are risking on each trade and how much money you will lose if price do not go as planned. That is basically the whole concept of risk per trade. And the reason why risk per trade is so important is because if your risk per trade is way too big, you will blow your account and you will lose a lot of money and you will never become profitable. As scary as that sounds, but that is the truth. Let me just sketch it out for you guys to see. So let's say you have $100 in your bank account. I mean, not your bank account, your live trading account. And you risk about 10% on each trade. So risking about 10% on each trade means what? You are risking $10 on each trade. Okay? $10 on each trade. Everything is good and stuff. So you actually start off with $100, and then let's say you lose your first trade and then you lose 10%. So now your $100 has just cut off down to $90. Okay? $90. And then you lose another trade and now you're cut down to $80, right? Cut down to $80, $10. And actually, wait, no, it doesn't work this way. If you are sticking to the 10% rule and you lose your first trade, right? Let's say you lose your first trade, you lose $10, okay? You lose $10. So the original balance was $100 and you lose your first trade, 10% is $10. And then now you adjust this 10% to this new account balance, which is $90, and 10% of $90 is what? $9. Okay, so you lose another $9. So in that case, you are down to $81. And this just keep on going and going and going, where you are losing $8.1, and just slowly you watch your account. What is this? $8.1, $81. I can't do math. 91, 8, 3. Oh my god. My mind literally can't think. It's been so long since I do math, bro. 1, 7, 7. No, 7. Oh, 3. $73.1. Oh my god, it took me so long to do this basic math. God damn it. Yeah, $73.1. And you can see, right, if you lose like, let's say 10 trades in a row, right, you'll probably be down to $0 or something like that, right? 11 trades or 12 trades in a row, and you'll be down to $0. That is why risk per trade is so goddamn important, right? You need to make sure that, you have much more room for error, right? You need to make sure that you have room for error, so that even if you lose multiple trades in a row, even if you encounter a losing streak, which is so goddamn common, you will still have money that you can trade with, right? The last thing you should be doing is this. This is a negative scenario. This is a very bad example. Now let me show another example where same scenario right here. You lost. Let's say you lost 10 trades, right? You lost 10 trades in a row, right? So another scenario right here where we, instead of risking 10% per trade, we are risking only 1% per trade. So every time you lose $100, you are losing what? $1, right? $1. In this case, you lost 10 trades. After you lost 10 trades, you will be down $10 or something like that, around $10. And in this case, right, guess what? Both guys, both trader A and trader B, they both lost 10 trades in a row. But trader A have $90 left in his account to trade, while trader B has $0 goddamn dollars in his account. So in this example, I literally have shown you guys how important risk per trade is. If you practice proper risk per trade, you will have enough money to trade with. Our goal as traders is not to look at the upside. It's never to look at the upside and how much money that we can make. It's always to look at the downside, which is how much money we can lose. If you trade with this mindset, you will become profitable. If you stop focusing on the money and how much money you can potentially make, right, and actually start thinking about, oh, if this trade does not go as planned, how much money will I lose? If you genuinely start trading in with this mindset, right, you will start to, take trades with much more caution, and instead of taking those impulse trades where, you get in and use a position size that is way too big for your account because you are a bit greedy and you want to see how much money you can make on this trade. Oh, if I make this one trade and I win this trade, I'll make like $1,000 in my bank account. That shouldn't be the mindset when it comes to trading. So what is the general rules for risk per trade? Did I even mention about the general rule about risk per trade? I hope so, right? Basically, the general rule about risk per trade is to risk about, not this pen, is to risk about 2% to 3% of your total capital. 1% to 3% actually. The minimum can be 1% to 3%. Right, the reason why we choose this risk per trade is because it's not too low and it's also not too big. And it's just nice. It's a very sweet spot where if you risk 2% on each trade, you can lose like 50 trades in a row, then you blow your account. If you use 3%, you can lose like 30 trades in a row before blowing your account. You can see, you can have so much more room for error where you can lose a lot more money and you'll still be good, right? Still be good if you have a proper risk to reward ratio, which is the next thing we're going to discuss. But for now, just understand this, right? If you can lose less and make more, then obviously you're going to become profitable, right? This is common sense. But why are 90% of traders not profitable? Even though it's a common sense thing to do, that you need to win more money than you lose. It's because of this thing right here. It's because of this thing right here. We don't practice proper risk management. These 90% of traders that lose don't practice proper risk management. So stick to this rule, 2% to 3%. So if you have $1,000 in your account, you should only be risking $20 on each trade, right? If you're $20 to $30 on each trade. So risk 2% to 3% of your total capital, your risk capital, and you'll be good. So in this lesson, we're going to talk about risk to reward ratio. And the thing about risk to reward ratio is basically how much you are risking and how much you are getting back in return is this ratio right here. So if your risk to reward ratio is 1:3, that means you are risking 1% to make back 3%, right? So if you lose this trade, you'll lose 1%. If you win this trade, you will win 3% for your total capital, right? So that is basically the premise of risk to reward ratio. And the rule is that we never ever want to trade with a risk to reward ratio of 1:1 or less, right? Never ever trade with a 1:1 risk to reward ratio. Just think about how stupid that is. You enter for a sell here. Okay, actually let's just use this example, use this chart, right? You enter for us, let's say you enter for a sell right here. Your stop loss right here, above this, and your take profit right here. In this case, 1:1 risk to reward ratio. You risk probably about $10 on this trade because your account only have like what, $100 or something. No, $1,000. So you use 1% on this trade, $10, and you make back another $10 right here. In that case, that is absolutely stupid, because why would you take the trade to make back something that is equivalent to your risk? You always want to make sure that your reward is bigger than your risk, right? That's literally the least you can do. And that is how you can really become profitable, if you can stick to this risk to reward ratio. And that is why the minimum risk to reward ratio I would advise you guys to look for is 1:3, right? 1:3. That means in that case, you are risking 1% right here to make back 3%. You can see, risking 1% to make back 3%, and it gives you a 1:3 risk reward ratio. So in this case, if you risk $10 here, you lose $10. But if you win $30. So that should be the minimum, right? That should be the criteria, the standard when it comes to risk to reward ratio. For me, I like 1:3, but for you, you might be going with 1:2. And the thing about risk to reward ratio, it kind of depends on your win rate. If your trading strategy have a higher win rate of like, let's say 80%, then in that case, you can have a lower risk to reward ratio. And if you have a minimum of 1:2, that means you need to have a higher win rate now. So that means your strategy must win more trades, if that makes sense. So let's just quickly go through risk to reward ratio and why it's so goddamn important. So let's say I enter for a buy right here, right? Maybe I enter for a buy right here. I saw there was some sort of support area here, right? Support area right here, and then I went down to the smaller time frames right here. Let's say I go down to the smaller time frame, and then I entered for a buy right here at this support area. Let's just pretend I'm a retail trader. So I entered for this buy position right here at this support area right here, and then my take profit was all the way up at this resistance area right here. You can see there's a little resistance area right here. So I place my take profit all the way up here. In this case, this is I'll place my stop loss below this support level right here. In this case, this is like about a 1:4 risk to reward ratio. So if I win this trade, I win 4%. If I lose this trade, I only lose about 1%. So let's just assume that our account balance have $1,000 in our account. And then we are risking 1%. I mean, no, we are risking 2%, right? Our risk per trade is 2%, the standard 2% per trade. And in this case, the risk to reward ratio is 1:3. In this case right here, you're risking 2% per trade, and 1 here means 1 unit, right? So in this case, you are actually risking 2% to make back 6%, right? 1:3 risk to reward ratio, guys. So this is a 2% risk, and this is a 6% reward, right? Very, very simple concept. So far, so good, right? We are risking 2% right here to make back 6%. So if I lose this trade, right? God forbid I lose this trade, I will lose about $20 on this trade. If I win, I'll win about $60 on this trade. Right? Sounds fair, right? If we lose, we will lose about $20, and if we win, we will win about $60 on this trade. In that case, I'm perfectly okay, right? That is okay, and I'll take this trade. But, let's say you were a little bit late. You did not got this entry right here. This is really like the best entry. No, actually the best entry will be all the way down here, and you can see it's like an insane 1:15 risk to reward ratio. But let's say you don't get the best entry. Instead of entering right here, you actually enter a little bit late, right? You open the charts, you just wake up and you already see price up here, but still you feel the need to, you know, enter this trade. You feel like FOMO, so you enter right here. In that case, if you enter right here, where should your stop loss be? You should always be placing your stop loss based on the market structure, right? So you place it below this support area right here, right? It's the same thing, placing it below this support area right here. And then your take profit, where should it be? Same area, this resistance area right here. So in this case, right, in this case, you can see this is actually like a 1:1 risk to reward ratio. And I will not take that trade. I will not take this trade. I'll tell myself, you know, the bus has already went. You've already missed this opportunity. It's already too late. You should not be entering for this trade now. Now, in that case, what's the proper risk to reward ratio that you should aim for? Like I said, 1:3. 1:3. The minimum is 1:2, right? That's the minimum. Less than that is just absolutely no go, right? So another example, let's say I actually managed to, you know, enter on this pullback right here. So enter for a short position right here, somewhere right around here, place my stop loss above this resistance area right here, and take profit all the way down at this area right here. And actually maybe I entered like somewhere right around here. I entered somewhere right around here where there was a 1:2 risk to reward ratio. In that case, when I say aim for 1:3, right, that is somewhat like the scenario where it's perfect, right? 1:3, higher than 1:3 is perfect, right? That means you're risking a very small amount of money to make a lot of money. 1:10, that is absolutely best, right? The higher the better. But let's say we saw this opportunity right here. Maybe right here, we saw all the confluences in the world line up, right? You can see the light bulb in your head lighting up, telling you should enter for this trade because you have all the confluences in the world. Oh, you have this candlestick pattern, price at this zone, order block here, and then supply demand here, Fibonacci here. You get all the confluences, all the signals from the market telling you that you should enter for this trade, right? So this is a trade that you can be very confident on. But I don't have a risk to reward ratio of 1:3. I only have 1:2 right here. The question becomes, will I still take this trade? Right? I get this question a lot. Will you still take this trade if it's less than your risk to reward ratio, but it's a very high quality trade setup, right? It's a setup where there's a very high chance that price will go in that way. In that case, yes, I will do it. But if same exact scenario, you have all the confluences in the world and you have all the signals telling you that you should enter for this trade, but instead of 1:2, it's actually 1:1. Will I still take this trade? The answer is no, right? The answer is no. So that is basically the concept I want to drill into you guys for risk to reward ratio, is to make sure you aim for 1:3, right? At least 1:3. That is a very good range, right? That means you can, lose 3 trades in a row, and you just need to win one. Guess what? You will end off as break even, right? You will end off as break even, and it's very common to lose 3 trades in a row. So you just need to win one and you're break even. How beautiful is that? That is why you guys need to have a proper risk to reward ratio. Because if you have a 1:1 risk to reward ratio, once again, right? You lose 1 trade, and then you lose another trade, and then you lose another trade. Now in this case, right, you need to win back 3 trades in order to break even. You can see it's a little bit different now, right? Just now, you can literally lose 3 trades in a row, win one, and you're break even. Now you lose 3 trades in a row once again, but you need to win 3 trades in order to break even. It becomes much more harder to grow your account right now because you are not focused on preserving your capital. So take into account this risk to reward ratio, follow this strictly, and you will have a much more higher chance of becoming profitable. Maximum account exposure. Quite simply put, it's basically your drawdown, right? It's basically your drawdown. You know how when you enter a trade, right? Let's say, once again, this is a chart right here. And let's say you enter for a buy position at this support level right here, right? You enter for a buy right here, enter for a buy right here. And price actually end up going against you for a little bit, right? Going against you a little bit. And you will start to see your account balance. -$10, -$20. You can see the loss starts to get bigger and bigger, right? And that's the floating loss, right? The floating loss, where is basically what we call the drawdown. It's not realized yet. It's not closed yet. If you close the trade at -$20, then that is realized. Then that is your close loss, your realized loss. But in that case, if it's floating like this in your account balance, you can see on your MetaTrader 4 at the top right, it's showing you red color, negative this amount. That is what we call the drawdown. In this case, what should your maximum account exposure be limited to? What's the max amount of money that you should be allowed inside your drawdown? 5%. Generally, 5%. That is my rule. So let's say you stick to the rule of risking 2% on each trade. In order to get a max drawdown of 5%, at all times, right, you should only be having like 2-3 trades open that is risking 2%, right? 2%. Let's say you have 3 trades, right? 3 trades, and all of which is risking 2%. In that case, your drawdown, the maximum is 6%, right? The maximum is 6%, where you actually all your trades hit stop loss and you lose 6%. But in that case, the drawdown should only be 5%, like the maximum. If it's a little bit confusing for you guys, let me simplify it even further, right? Basically, drawdown right here, just remember, the maximum is 5%, right? That's the maximum. And in that case, if you know that you're going to risk 2% on each trade, you shouldn't have more than 2 trades open inside your account, right? You shouldn't have more than 2 trades open inside your account. So what that means is that 2%, let's say I open 1 trade on a long position, risking 2% on this trade, okay, this exact trade right here, and I bought in for GBPUSD, right? GBPUSD. So this is my first trade. This is my first trade right here. Then my second trade, I saw an opportunity for me to scale in for this position, right? I start seeing price reverse right now. Actually, no, it didn't reverse, right? Actually, price is continue going down, but I'm still so confident that, you know what, price is gonna go up. And right now, price is at a discount, right? Price is cheap. So buy low, sell high, right? So I should enter for another buy. So this was my first buy position, and I entered for another buy right here. But then price just keeps going down, keeps going down. And at that point of time, on the second trade, you risk another 2%. I'm trying to find a way to articulate my thoughts properly, and I'm trying my best here, guys. But I find another way to, risk another 2% on this trade right here. So in total, we are risking 4% right here. Total 4% on this GBP USD trade. So the worst case scenario is that if we risk or rather lose both trades, we will be down 4%. That's the worst case scenario. But right now, price is just going against us. It haven't hit our stop loss yet, because my stop loss could be like right here. It haven't hit our stop loss yet. It's just going against us right now and started retracing a little bit and then go down even further like this. Right? In that case, my account is in drawdown right now, right? My account is in drawdown right now, and it could be negative 3.5% or what. Right now, whatever it is, the drawdown is the floating loss, right? We don't know what it is because we don't know the exact price. But this is the floating loss, and it's not realized yet. Until price hits your stop loss, this is just floating loss, right? Until price hits your stop loss or you close the position, then the loss will be realized, which is negative 4%. So when I say that your maximum drawdown, your maximum account exposure should not exceed more than 5%, what I mean by that is that the amount of open positions that you have, right, and you add up all the drawdown, if the trade does not go as planned, add up all the drawdown, it should not be more than 5%, right? It should not be more than 5%. So if you use the 2% rule, at any point of time, you should have no more than 2 open positions at once, right? So stick to this rule. If your maximum account exposure is 5% and you're risking 2% on each trade, at no point of time you should have more than 2 positions that is open at once, right? So if you enter for the first trade and you do decide to scale in for another trade right here, so you have another trade right here, you have 2 trades running to your take profit or stop loss or whatever right now, right? You shouldn't open a third trade. You should limit yourself to those 2 trades. You need to practice self-control and limit yourself to 2 trades just so that you can stick to this maximum account exposure right here. So next, I'm going to talk about position sizing. So when it comes to position sizing, there is actually 3 factors that you guys need to take into account of, right? And the premise is basically, a lot of you guys don't know what's the correct lot size to use for your trades, right? And it's very important, because if you use a lot size that is way too big for your account, you will ruin your account. If you use a lot size that is way too small for your account, you will not grow your account. And I always say that you need to use the correct position size, because if you can do that, then you have an ideal scenario where you can have what I call a big win, right? Your big win. Let me tell you something. Your trade should always only end up in 4 ways. I mean 3 ways. Wait, 4 ways. Okay, your trade will end up in 4 ways. Big win, small loss. But it should never ever be a big loss. And we do that by adjusting our position size, right? So that we can get a big win and also we can get a small loss, right? So once again, comes down to 3 factors right here. So to answer the question, what is the correct lot size that you should be using on each trade, you need to take into account these 3 factors here. Let's go through one by one. So we know the risk capital is basically how much money you have inside your account balance, right? It could be $1,000 or $500 or $10,000. How much money you have inside your trading account, that is your risk capital. Next, we talk about how risk per trade, we should risk about 2% to 3% per trade. For this scenario here, let's just stick to 2%, right? Stick to 2%, that's my standard. Now, the stop loss distance. This is something that is a little bit tricky, because we don't have like a fixed predetermined number of pips for our stop loss. And that is another point I want to say. You should never ever want to go into trading with the mindset that, you know what, you always want to make sure that you get the tightest stop loss and have like a 5 pip stop loss every single time. That is extremely unrealistic, and that is extremely stupid and a very dumb way to trade. if you go into this mindset where every single trade that you take need to have a 5 pip stop loss, right, you will end up taking very bad trades that are not really profitable. That is why you need to place your stop loss based on market structure and place it at a level where it will invalidate the setup if it is wrong, right? If the trade setup is wrong, you will invalidate the setup. So we know that in an uptrend, right, price creating higher highs and higher lows, right, you should be placing your stop loss at all these higher lows right here, a few pips below these higher lows. And if you are trading some sort of order blocks or supply and demand or support and resistance, right, and you actually, let's say, buy at this demand area right here, right, this key level here, stop loss will be below this key level. And same thing over here that we have right here. If you sell at the resistance right here, your stop loss should be above this resistance, right? So that is your stop loss distance. And by the way, this works for supply and demand, order blocks, support and resistance, whatever that involve like key levels or zones that institutions are entering for the trade. Place your stop loss above or below that zone, depending on whether you buy or sell, and then place it like a few pips above or below it, right? If you don't understand where to place your stop loss, then you should go watch the videos where I talk about trading strategies and actually like trading. This is a risk management course, so I'm not going to dive into where to place your stop loss. But if you still don't have a clear understanding of that, go watch the trading videos. So, position sizing. In order to choose the correct lot size, you need to take into account these three things. And a stop loss distance, and it could be like a certain amount of pips, like 30 pips or even 50 pips, right? Depending on how wide is your stop loss and what type of trading style you are. Maybe you are a scalper. A scalper will probably have like a 5 pip stop loss, like a very tight stop loss. But then intraday trader or swing trader might have a 30 pip stop loss, which is much more wider, right? So now, before you enter for the trade, I want you to do this one thing to determine what lot size you should use. And that is to go and calculate what is the correct position size you should be using. Let me give you an example. So let's just go to the charts and I can just give you, let's say we buy at this support area right here, right? And then we aim for this little area that we have right here, this resistance zone right here. And then we place our stop loss below this support area right here. Now, before you enter for this trade, right, there is 2 criteria that must be met, or what are the 2 things that you must do. The first thing is to, do this forecast where you place your stop loss and you place your take profit to see your risk to reward ratio. If it's more than 2, then by all means, go ahead and take that trade. If it's less than 2, do not take that trade. Second thing you need to do after you do this is to go and calculate what position size you should be using. So in this scenario right here, let's have an example where, once again, we have $1,000 in our account, right? $1,000 in our account. And then we are risking 2%, right? 2% risk, and that gives us $20. That means we are risking $20 on each trade, right? The 2% risk per trade. Now, in that case, our stop loss distance here is 11.6 pips, right? 11 pips stop loss. So I'm just going to put 11 pips stop loss. We actually should round up, right? Always make sure you round up. So 11.6, you can round up or you can just put in the exact number, but I like to like round up so that it's like a nice whole number. So 12 pips stop loss, and this will be, that's the stop loss distance. The stop loss is 12 pips. So these are the 3 information that you need to input inside your position size calculator. And that is where you will find what lot size you should be using. So if you just go to Google and search position size calculator, right? And I'll recommend you guys to use the first one right here. This is actually the one that I use by my FX book. So you click on right here and you'll come to this page right here. And like I said, just now, the reason why I asked you to input this information right here is because you need this information so that you can actually determine what's the correct lot size you should be using. So let's just input it. Account balance is $1,000. Account size is $1,000. So that's 1,000. And also make sure you choose the currency pair that you're trading. In that case, you are trading AUD USD, right? And then this account currency is basically the currency that your account is on. Is it on USD, AUD USD, or what? No, but default should be US dollar. And the risk to reward ratio, this is not your risk to reward ratio. This is your risk per trade percentage. So if you are risking 2% on each trade, your risk per trade is 2%, then here just put 2. As simple as that. Just put 2. If you're risking 3% per trade, then put 3. As simple as that. So in this case, we are risking 2% per trade. And what's the stop loss that we have right here? We have a 12 pip stop loss, right? You can see this is a 12 pip stop loss. And we made sure that we placed it at a level where, you know, if the trade does not go as planned, and it actually goes down here, we minimize our loss at a price where it would actually invalidate this setup, right? Because if price actually reverse and go back down, right, this shows us that, you know what, maybe price will break through this support area, and, you know, it's not going to go up anymore, right? It's not going to respect this support area anymore. So this was a trade that is going to be lost anyways. So 12 pip stop loss, and just put it in right here. Press calculate, and there you have it. As simple as that. This is the lot size that you should be using. So at this point of time, after I get this figure here, I will go on to my position size calculator and just type in 0.17, and then I'll place the buy order. And ladies and gentlemen, that is how you calculate the correct lot size per trade. Let me give you guys another example in case you guys don't understand. Maybe let's just go to USD JPY, right? A yen pair. So in this case, right, let's say you enter for a buy right here at this higher low right here. You can see where's the buy to right here, and I place my stop loss below this last higher low right here and take profit all the way up at this resistance area that we have right here. Right here. Yep. So in this case, you can see this is like almost a 1:2 risk to reward ratio. And in this case, let's have another example where maybe we are risking our account balance is $5,000, and our risk per trade is about 3%. Let's say this time around we risk 3% on each trade. And this case, our stop loss resistance is what? 33 pips. You can see right here, 33 pips. So stop loss is 33 pips. Now, this is literally all the information you need. Once you get all this information, just go to position size calculator and choose the currency pair, which in this case is USD JPY, and then account size is $5,000 this time, and the risk to reward ratio is 3%, right? Just 3% right here, and then the stop loss is 33 pips, and just press the calculate 0.68. This is the lot size you should be using for this trade right here. So we'll go on to MetaTrader 4 and actually input the lot size as 0.68. As simple as that. As simple as that, right? By doing this, you are able to ensure that you use the correct lot size while respecting your risk per trade. And I can't emphasize how important this is. Like, it is absolutely essential that you make sure you do this. You do this before you take the trade. No matter how, like, you know, how good the trading opportunity is, you should not be the case where you enter, like, let's say on this trade you enter a one lot size, right? Because you saw this impulse move and you start feeling this fear of missing out, and you immediately go on to your MetaTrader 4, press USD JPY, enter for a buy, and you don't know what lot size to use, but you just, you know, just say, okay, you know what? This is a confirm win one. You confirm will win this trade one. So I'm going to enter a big lot size, one lot size, and boom, enter for the trade. That is the wrong way to trade. You need to do this thing before you take the trade, right? Calculate the correct position size first and then enter for the trade. If you can do this, I can guarantee you that you will be profitable. If you can practice, or rather apply everything that I'm talking about in this risk management framework, this risk mitigation framework course, and you actually apply it, I can guarantee you that you will become profitable. Alright, so before you do anything, before you take the trade, make sure you go to this position size calculator and just input the information so that they can just do the job, and you can see it's so easy, right? It's just one button, and this probably will take you only about like what, 10 seconds or even 15 seconds. Okay, less than 1 minute, alright? It takes you less than 1 minute to save you hundreds of dollars, even thousands of dollars. So do it, and just don't trade based on impulse, alright? Trade based on rational logicality. Just trade based on rational and logical, and just use this calculator here. Now let's talk about how leverage works next. So firstly, what is leverage? Basically, let's say you have $1,000 in your account. And then when you sign up for a live account or a demo account even, right, the broker will allow you to choose what is your preferred leverage, right? There's usually options ranging from 1:20, 1:50, and then there's even 1:100, right? Basically, the broker will allow you to choose which leverage do you want. Now, let's say you choose 1:100. That's the leverage they will choose. And remember, you have $1,000 in your account. So if you have a leverage of 100, that means 100 times $1,000. And this means that you have a buying or selling power of $100,000. Right, so essentially this leverage is acting as somewhat of like a borrowed capital that allows you to make more money by trading with a bigger account size, or rather like a bigger lot size. That's what I mean. And it's a double-edged sword, right? Leverage is a double-edged sword. It can increase your wins. It can also increase your loss. Right? It's a double-edged sword. That is why you want to make sure that when you're choosing what is the correct leverage to use, or rather what leverage that you want to use, it's not way too high. It's not too ridiculous, right? And my honest opinion would be to just stick with 1:50 and not go any higher than 1:100, right? 1:100 is the max, right? Because if you go up to more than 1:100, where you even go to like 1:500, 1:1000, right? First of all, those brokers that offer such high leverage are most likely unregulated, which means they are not safe, they are not licensed, and they might run away with your hard-earned money. Second of all, it's way too much, right? In that case, you are already over leveraging. You are already, risking too much of your capital, right? And let's say in this case, you decide to go with a 1:100 leverage, and you have a buying or selling power of 100K. What this means is that you can trade up to a standard lot size, which is a 1.0 lot size, right? You can trade up to a standard lot size. That means every time price move by 1 pip, guess what? You are making $10 per pip, right? $10 per pip. But without leverage, let's say you take leverage away and you only have $1,000, and that means you can only trade with $1,000. Right, so you have $1,000, you can trade with $1,000. In that case, do you think you will still be able to use this 1.0 standard lot size? No, because you need 100K inside your account in order to trade one standard lot size. In this case, you can probably only trade like the smallest lot size possible, which is the 0.01 lot size. You can't even trade a mini lot. You can only trade the smallest lot size, which is 0.01 lot size, where you are making literally pennies. Right? You are making literally pennies, 10 cents per pip. This just shows you the power of leverage. With leverage, you are able to trade with bigger lot size. Right? That means that you can have a very small amount of money inside your account and trade with lot size that is bigger than usual because of leverage. That means you're able to risk more money than usual and you can make more money than usual. But bear in mind, like I said, it's a double-edged sword, right? If you want to win more money, that also means that there's a chance that you're gonna lose more money. So the thing about leverage is that, honestly, all of this stuff won't matter if you follow your risk management plan. If you strictly follow your risk management plan, then you won't be, going overboard with leverage. You won't over leverage. So let's say you stick to a 1:100 leverage and you have a 100K account, right? If you're calculating your risk per trade, it should not be based on this amount here, right? That means that if you are trading with this account right here, you have $1,000 and you deposit into this broker which offer you 1:100 leverage, that means you can trade up to 100K, right? You should not, let me repeat myself, you should not be calculating your risk per trade based on this amount here. Your risk per trade should be based on this amount right here, which is what you have inside your account. Because just now I talked about how risk per trade is a percentage of your risk capital. In this case, this is your risk capital right here. Right? This is your risk capital. And this is just imaginary. Alright, let's just imagine this is like a imaginary risk capital plus borrowed capital from the broker. So 2% risk per trade would still be your $20, right? It will still be $20 on this trade. So leverage doesn't really change your risk management plan. It just amplifies it and give you the ability to trade with more money so they can grow that small account faster, right? And actually sustain in the game. Now, the next thing I want to discuss, which could be quite useful for you guys, is actually stops and limit orders, right? This is just an additional thing that you guys can, or rather you want to know, then just go ahead. But if you don't, then just continue entering into trades manually, like pressing the buy or sell button manually. But if you want to find a way where it's like automated, that means that if price reach a certain level, your broker will automatically get you into that position, either for a buy or a sell, depending on what limit or what stop order that you use. So there is basically 4 ways where you can automate this process, and that is through buy stop, sell stop, buy limits, and sell limits. Let's go through one by one. So buy stop is where you place a buy order above the current market price. So let me just maybe draw some example for you. Right, let's right here. So let's say price is creating an uptrend, right? Price creating an uptrend, and you want to place a buy stop order right here when price break through this high area. So you'll place a buy stop right here. So right now, price is going up and you won't be in the position, all right? You can maybe be at the gym or spending time with your family and you're not looking at the charts. So never mind, go do that because you already place a buy stop order right here. So if price reaches this area, your broker will automatically get you into a buy position, and that is what price did right here, okay? So right now, you're inside the buy position right here. And this is what we call a buy stop, right? This is what we call a buy stop. But in this case, what if we don't want to trade the breakout of this high, right? We want to trade the pullback, right? Oops. So in that case, I want to wait for price to pull back to maybe like right here, somewhere right around here, and then that is when I will enter for a buy position right here. In that case, you can't be using buy stop because buy stop is an order that is placed above where currently the market is at. But right now, you want to enter at below where the market is currently at. So in that case, you won't use a buy stop, you will use a buy limit, right? It's basically an order placed below the current market price. So this is below the current market price, so you place a buy limit right here. So once again, price will come back down here. Your broker will get you into a buy position right here at this low point. And yep, just continue to watch your profits skyrocket. Now, on the other hand, let's just switch to maybe a downtrend, right? Maybe not even a downtrend. Let's just use another example of just a consolidation. So there's a resistance area right here. There's a support area right here. Or rather what you want to call supply zone or demand zone, all right? So let's say price comes down to this area right here. And it's showing a lot of selling momentum, a lot of liquidity, right? A lot of liquidity. Price is just crashing down a lot and it's coming down to this area right here. And you are predicting that price is going to pierce past this demand zone, right? It's not going to respect this area right here and just going to crash and just pierce past it. In that case, what you want to do is to place a sell stop, which is an order placed below the current market price, right? So this is the current market price and this is where you want to enter. So it's actually below the current market price. So you place a sell stop right here. Once again, once price hits this area here, broker will automatically get into a sell position. And yep, that is how it works. But in that case, let's say price decide to reverse at this area here, right? Reverse, creates high highs, high low, high highs. And you actually want to enter for a sell order at this supply zone because you know that there's a lot of sellers waiting at this supply zone, a lot of liquidity to be grabbed right here, right? And you know for a fact that this is a very strong supply zone and price will respect it and reverse at this area. So in that case, you'll place a sell limit, right? Because this is the order and it's placed above where the current market price is, which is right here. So price will go up here, smash your sell limit right here, activated, and that is when you enter for sell position. So this buy stop, sell limit, buy limit can be very useful, especially if you are trading order blocks, right? Or supply and demand zones where you know you want to enter for the trade immediately when price touches that area, right? Immediately when price comes back to touch this order block area, you want to enter for a buy order right here, right? And in that case, which one will you choose? Will you choose a buy stop or buy limit? Obviously, you're going to choose a buy limit because you want to wait for price to come back down here, touches this area, right? And this order is below where the current market price is. So yep, use this if you want, and I believe that this will be a very like useful tool where you can save a lot of time.